A share market, also called an equity market or stock market, is a marketplace where investors come to buy stocks of listed companies and attain a portion of ownership, whereas companies come to raise capital. Let's understand how a company gets listed. Consider a company that wants to raise funds to expand their business in exchange for its shares. It can approach investors such as angel investors or financial institutions, or it can list on the stock exchange to raise funds from the public. A stock exchange serves as a platform where investors can buy or sell stocks. The two main stock exchanges in India are the National Stock Exchange (NSE) and the Bombay Stock Exchange (BSE). Now, to list on a stock exchange, a company has to file a detailed offer document to SEBI containing all the necessary information. SEBI, the Securities and Exchange Board of India, is a regulatory body which creates laws and supervises the market with a goal of protecting investors. SEBI approves the listing of the company after it meets all the necessary criteria defined by the SEBI. After receiving all necessary approvals, the company applies for an IPO, initial public offering, on the primary market. The process of selling stocks for the first time by a company is called an IPO, and the place where they are sold is called the primary market, where companies sell shares directly to investors. Once these shares are listed, they enter the secondary market, where daily trading occurs. In the secondary market, shares are traded between investors where the company that issued them is not involved in these transactions. After listing, a company can raise additional funds by issuing new shares through an FPO, follow-on public offer on the secondary market after SEBI's approval. Now let's understand how stocks are traded between investors. Investors through stockbroker opens a trading and Demat account. A trading account is for buying and selling stocks, acting as a transaction platform, whereas Demat account acts as a digital locker where stocks are stored in electronic form. A trading account is with a stockbroker, while a Demat account is with a depository participant (DP), which are agents of a central depository like NSDL or CDSL. Now, to buy a stock, an investor transfers money from a linked bank account to a trading account where the buy order is placed for a stock at a particular price. Now the broker will pass the order to the stock exchange where the stock exchange finds the matching order, which is a sell order from another investor. Once the quantity and price are matched, the trade will be executed. The shares will be debited from the seller's Demat account and credited to the buyer's Demat account. Let's understand what are Nifty and Sensex. Nifty, also known as Nifty 50, is a stock market index that tracks the performance of top 50 companies of the NSE. The companies are selected by considering their average free float market capitalization. Free float market capitalization is the total market value of a company's shares that are available for trading to the public, excluding shares held by promoters or financial institutions. Similarly, Sensex is the group of 30 companies from BSE. That is all for today's video. Thank you for watching. If you liked the video, please subscribe to the channel.